1.2 million Canadians are going to be renewing their mortgage in 2026. And the crazy thing is over 85% of them sign rates sub 2%. If you're one of them, you're staring at probably a payment increase whether you like it or not. And the only question is, how bad is this going to be? Because here's what's happening right now. The Bank of Canada just signaled that they're done cutting rates at 2.25%. And they said that's about the right level with core inflation still at 3%. Now you've got two options on the table if you're coming up to renewal and you know what they are: fixed rates or variable rates. Over the next 18 minutes specifically, I am going to show you why the choice you make in the next 30 to 60 days could cost you or save you about $18,000 of interest over the course of the next 5 years. Of course, this isn't theory. This is 1.2 million real Canadians making a decision that will define their financial reality, potentially up until the year 2030 or 2031, depending on when you're listening to this. Let's talk about what's actually at stake here. All right, before we get into the whole fixed versus variable, you need to understand the crisis that is unfolding right now, because the media, it's just not telling you the whole story. And I don't want to get overexcited, but I am, because it's a topic I talk about. So 1.2 million Canadians are renewing in 2025, with the vast majority of them having already done so. And we haven't seen, the amount of foreclosures that we expected, but 2026 is expected to be even bigger. So with over 85% of those mortgage holders renewing at rates over 4% or in the 4% range, from 1 to 1.5 to 2% ranges, that's a pretty massive difference. You locked in at 1.5 or 2%, you're renewing at 3.45 to 4%. That's more than double of the current mortgage rate that you hold right now. Now, 60% of all outstanding mortgages in Canada are expected to renew in 25 or 2026. This obviously isn't a small group of people. This is a systematic event. Now, let's just talk about a couple of interesting reports. RBC reported that the borrowers renewing in 2026 are facing an average of $513 payment increase, which is equal to $6,156 per year. And RateHub estimated that Canadian households will pay around $5,000 more every year after renewal. Now, if you think about what that means for your life, that $513 per month, that's your grocery budget, that's your car payment, that's your kids' activities, that's your vacation fund, gone just to keep the same house you already own. Now, interestingly enough, a Royal LePage survey, if you put any stock into that, found that 81% of those expecting higher payments, it's going to put a financial strain on these households, with over 34% of them saying that the strain would be relatively significant. And 60% of those plan to reduce or eliminate discretionary spending, with 43% cutting travel and 36% investing, saving, or investing. That's not a good sign for the country, which means 1 in 10 are seriously considering selling their home in what looks to be a continued declining market right now. Now, the CMHC says that mortgage delinquencies are already starting to tick upward, and even though the numbers are still relatively small, it looks like it could continue into 2026, with delinquency rates continuing to grow ever so slightly. Now, the scary part of this whole situation is that mortgage rate arrears in Toronto and Vancouver could reach levels unseen since 2012, as we've already started to see that happen. Now, here's the thing. We've got through all this scary stuff. Whether you're renewing at 3.5% or 4% on a variable or a fixed, you're facing a payment increase compared to your 1.5 to 2.5% mortgage rate. But the type of increase you face and whether it gets better or worse over the next 5 years depends entirely on your decision over the next 30 days if you're renewing your mortgage. Now, here's the thing. The perspective here sounds kind of brutal. You can't avoid the payment shock. It's coming no matter what options you choose if you just simply renew your mortgage. The question is, do you lock in the higher payment at the, let's say, 3.79% best rate fixed that we've seen in the marketplace and know exactly what you're dealing with? Or do you start at a variable rate of prime -1, which is about the bottom of what we've seen, and hope that rates drop further, knowing they could also go up? There's no good option here, only the least bad option for your situation. Now, here's the thing. Here's where it gets real, because the difference between making the right choice and the wrong choice, it's not $50 a month. It could equal $18,000 of interest over the next couple of years. And my goal is to help you make this educated decision. Now, we're going to use a base scenario of a $500,000 mortgage renewing from a rate of 1.5% to either a 3.45% variable or a 3.79% fixed. Now, the reason we're using these interest rates is because, again, they've been seen on renewal options, not necessarily, definitely not refinances, and specifically not most purchases, but for banks renewing mortgages, they typically offer lower interest rates. And so if you see those rates out there, this is what it's typically looking at. Now, if you had an old payment at 1.5%, $2,000 per month, your new payment at 3.45% of the variable is $24.71, which is a $471 increase. And your new payment on fixed is about $25.28, which is about a $528 increase. Either way, you're getting hit. The question is what happens next? Now, before I go any further, I want to preface by saying a few things. There are other options available to you. You don't simply need to renew your mortgage. This is a situation where you're just signing the paperwork with your existing lender, keeping your amortization as is, and moving forward. You do have the option of refinancing to extend your amortization period, and if you choose to do so, this could allow you to drop your monthly payment, therefore allowing you to have more flexibility in your budget. Either way, here's the catch. If you were to, let's say, for example, in scenario one, let's say the bank cut rates. Let's say the bank cuts rates another 75 basis points over the course of the next 12 to 18 months. Prime drops from 4.45% down to 3.7%. An unlikely scenario, but best case scenario. Your variable rate is now around 2.75%, and your new payments are around $2,300 per month. Suddenly, you're only paying $300 more than your old mortgage instead of $471. And over the 5 years, it's about $8,000 to $10,000 of interest savings compared to a fixed interest rate. But I think the catch in this scenario is that the bank already said rates are at about the right level. So core inflation at 3%, we're still above that target. For them to cut another 75 basis points, we need to see inflation crash. It's just a highly unlikely occurrence, even though there is a outside possibility. Second scenario is the Bank of Canada pause on rates. This is where we stay. We're in this rate hold position for the next 12 to 18 months. Your variable rate stays at 3.45%, your fixed rate stays at 3.79%. You save the $57 per month over the next 5 years. It's about $5,000 of savings. That's probably the best case scenario because we know the chances of rates going down significantly are unlikely, and chances there are rates could do what we're talking about next, which is rates obviously going up. Scenario 3, the more pessimistic view, this is the option that bodes well for a fixed rate mortgage, is that the Trump's tariffs hit, inflation spikes back up, Canadian dollar collapses, the bank forced to raise rates up, and we see your payment increase from a variable rate of 3.45% down up to 4.2%, which increases your monthly payment to $2,650. You're now paying about $650 more than your old mortgage, and over the course of 5 years, you lose about $7,000 to $10,000 versus had you locked in with that fixed rate. But there is a wild card scenario that most people, I don't think, actually talk about. You lock in at that 3.8% or 3.89% fixed rate on the renewal 2 years in. If you need to sell your property because you need to relocate your job, or you have to refinance because of debt, or let's say something happens in your family dynamic, whatever the reason is, the penalty difference of taking that fixed rate loan could end up costing you $13,000 to $17,000. So if there's any chance that you could sell, refinance, or need to break your mortgage over the course of the term, the variable rate advantage may be beneficial purely because of the interest rate savings. So if you're out there, you're probably thinking and asking the question, which rate is lower? And I think most Canadians should be thinking, what is the total cost that could be lower over the course of the 5 years when I factor in fees and penalties? Stopping for a quick second, the rates that I've used in this calculation are based on an assumption of renewals, not a new mortgage term. So of course, you're probably suggesting that these rates seem lower than you've seen in the market, and that could be accurate. Now, the next step of the process is to plan out and plan forward. You need to model the best case scenario, the best case on that rate hold, and the worst case if rates were to go up. You need to model for the penalty scenario and obviously the likelihood that you could break your mortgage early. Which outcome is most likely for your situation and the market as a whole? In that circumstance, you need to be conscious because you need to model out those 3 different scenarios. This is something that we do on our amortization calculators every single week when we're looking at the numbers. Now, here's where most people, I think, screw this up because they make the decision based on emotion or what their friends said instead of the math. And I think it just ends up costing people thousands of dollars. It's basically the FOMO trap, which is you hear variable rates are whatever that number is, the lowest that we've seen in years, and your brain says, I should probably grab this before it goes up. But you're not asking the question, will it go lower or is this as good as it gets? And the bank said rates are at about the right level, which is the central bank basically saying we're done unless something breaks. Your FOMO then says you should be going variable. But with the signal from the Bank of Canada, the question mark, is that the right question? The other thought is, well, the flip side to that is you think, I can't handle a rate increase because I need that certainty of the fixed rate. So you lock in at the higher fixed rate. But what if rates were to drop in 2026 and you're stuck at that higher rate until 2030, and then everybody with a variable rate is saving $200 to $300 a month? That's 5 years of you watching somebody else save money while your payment stays higher. And the question is, can you handle that psychology? The biggest thing, though, more than anything else, that you're going to regret more if you choose one or the other, is you choose variable and rates go up, you're going to regret not locking in. If you choose fixed and rates go down, you're going to regret choosing variable. So the question is, it's not how do I avoid regret? It's which regret can I live with? Because there is no perfect decision. Now, Royal LePage survey recently said that 66% of people said they plan to get fixed and 29% are looking at variable, with the other undecided. But what's fascinating is that those percentages are actually shifting right now. More people are considering variable than they were just a few months ago at 24%. And the reason for that is because variable rates came down faster than expected, and people are starting to believe that the rate cuts will actually continue. But bond markets are already pricing rates to stay basically flat for the course of the next year. So the question is, who's right? The optimists betting on more rate cuts, or the bond traders betting on stability in this marketplace? Now, something you should probably do, a next step in this process, to assess yourself. Assess your situation. If rates were to go up by 75 basis points and your payment increased by $180 a month, does that break your budget, or can you absorb that? 2, if you lock and fixed rates drop, will you be checking mortgage rates every month and torturing yourself, or can you accept the decision that you made? The third is, what keeps you up at night? Uncertainty or missing out? The fourth, do you have 6 months of emergency savings, or are you living paycheck to paycheck? And the fifth is, there any chance you move, sell, or need to refinance in the next 3 to 5 years? Your answer to those questions will actually matter way more than any rate forecast in any marketplace. All right, so we've covered this psychology. Now let's talk about what's actually happening with the Bank of Canada, because the public statements and the private reality are two different factors to consider. The public message is rates are about the right level. We're data dependent. We'll take it meeting by meeting, which is classic bank speak for it sounds like we're neutral and we're hanging out where we are. But the reality is the overnight rate is 2.25%, and that is what the bottom of their stated range is. So going below that 2.25% means the bank is actively starting to stimulate the economy. And they typically only do that if we're in a recession. Are we in a recession? No, we're not. You can argue that, but I'm saying we're not. Unemployment is at 6.8%, which isn't great, but we're not at crisis levels. And even though GDP came in soft, truth is we are not in an active recession. Core inflation right now is still at about 3%, with the target being 2%. They need that number to drop to 2% before they'll even think about cutting below neutral. But the problem is shelter costs and food remain one of the key contributors to inflation. And shelter inflation is still elevated, which means the cost of rent and mortgages is still relatively high year over year. So the question is, how does the bank get inflation down when the biggest component is still rising at 4.8% of expenses? They can't cut rates aggressively without making housing inflation worse. On top of that, you've got Trump threatening 25% tariffs. We've got issues with Canadian exports. If those crash and we see recession risk, the bank does need to cut rates to support the economy more. From a medium-term perspective, the Canadian dollar would collapse, import prices would surge, and we'd see massive inflation, which means the bank would need to raise rates to defend the currency. Which one wins? I don't know. Nobody really knows, but the uncertainty alone is keeping the bank on pause. Now, Canada has already implemented retaliatory tariffs, as you know, including the 25% on non-USMCA compliant vehicles, which adds inflationary pressure. But the thing that I'd rather talk about here is what's happening in the bond markets, because that's what indicates where the fixed rates are going. And I think that's what people need to hear right now. Right now, the 5-year government bond yields are still sitting around 2.7%. They're not falling. They're flat. That tells you that the investors, these professional investors, don't believe the cutting cycle has much further to go. Typically, when we see it hold like that, they also don't believe the market's going to continue to decline. So the other thing that you want to start to consider when you're making this decision is what I like to think of evaluation. An evaluation step is to read between the lines. The bank says they're data dependent, but what they mean is we're done cutting unless something breaks. For your mortgage decision, if you bet on variable, you're betting on something breaking. You're betting on a recession, a collapse in inflation, a global shock, most likely. If you're betting on fixed rates, you're betting the bank is telling one truth and the real truth right now, that we're paused and we're not going any lower than right now. So the question is, which scenario do you believe in more? Okay, so here's the thing. You've got all the information. Now let's make a decision using this framework that actually works. All right, let's put things into perspective here. The first thing is, you're not avoiding a payment shock. It's already happening. We're already seeing payments change. The question is, do you want predictability or flexibility? The second thing is, did you do the research to get the numbers? Did you look at your current mortgage balance, your current rate versus renewal rate, your exact payment increase, your emergency fund, your job security assessment, and the probability that you move in the next 3 years? The third thing is, did you evaluate what the BOC is actually saying? Look at the market trends. Obviously, as I mentioned, are we at the right level? There's another meeting coming up. Is there a chance of a cut? Could we see rates going up? Did you assess your situation more specifically by planning best case scenario, worst case scenario, and penalty case scenario? Did you assess your actual personal circumstance, which means can you absorb a monthly payment increase? Do you have 6 months of emergency funds? Will you obsess over rates changing? And will you regret missing savings if you went fixed instead of going variable, or vice versa? Lastly, execute, make a decision, commit to it, stop checking rates every single day. You made the decision, the best decision that you could at this time, so stick with it. Now, the final thoughts are, who should actually go variable right now? First things first, you got 6 months in emergency savings. You can absorb at least $150 to $200 payment swing one direction or the other. You might move or refinance in the next 2 to 3 years or 4 years. You're comfortable with uncertainty, and you believe that the BOC could see rates coming down over the course of the next year. Those who are on the other side of the coin, maybe fixed, people should choose fixed if they have a tight budget, limited emergency fund, you're staying put for a longer period of time. You need that sleep at night certainty, and you believe the bank is done cutting. There is a hybrid option. There is a third scenario that I don't think many Canadians are actually thinking about right now, where you can put 50% fixed, 50% variable. There's only some lenders that do this, but it could make sense for someone right in the middle or who is undecided. And lastly, there is another scenario that we haven't talked about much in this video, is that if you're in a situation where you have a high amount of debt, you're worried about your monthly payments, again, we can look at utilizing that equity to pay down that debt and or reducing your monthly payments based on stretching it out all over again. We don't recommend doing this every time, but it could solve your short-term problem. So you've got a decision to make now. Here's exactly what you should be doing if you're trying to make this decision. Number one, gather your information, get your renewal offers, call us to find out what the market is doing, request both fixed and variable rate options depending on your goals, and ask the person that you're talking to more about what options are available for conversion clauses, penalties, or prepayment penalties. The second, run the different scenarios. If you're trying to do this on your own, you should model different scenarios for a rate increase, a rate staying flat, or a rate decrease. If you're working with a mortgage broker, ask them to help you do that for you. Factor in your emergency fund and make sure that's a part of your big picture. The third thing that you want to do is use your framework. I gave you a framework here today. Use that to make a decision. Assess your risk and make the call one way or another. Lastly, that is where it's at. Make the decision, move forward. If you're renewing your mortgage with your own bank before moving on, or if that's your final call for one reason or another, then don't ever accept what the bank is offering as their own offer. Remember, it costs them less money to retain you. You're typically going to get lower rates there than you are in the marketplace, so they better be providing that to you unless you're looking at making any changes. And lastly, like I said, sign the paper, make the decision, or move forward, get the approval with the mortgage broker that you're looking to get work with. Now, there's a couple big dates that are coming up. If you're listening to the end of this episode that you should be paying attention to, December 10th, we've got the next BOC decision, January 29th, and we're watching these inflation reports to see what happens over the next little bit. If it's worth noting, what I'm watching is what's happening in the trends of core inflation, what's happening with Trump, how are the bond markets reacting over the course of the next 30 to 60 days, and looking at these mortgage delinquency rates to understand what's happening. Now, here's the bottom line. If you found this helpful or useful, first of all, hit that subscribe button, give me a thumbs up. If you'd like to find out more about this framework and you want help making decisions for yourself, you don't want to do it on your own, we model this out for our clients, just hit me up on Instagram at The Mortgage Pug, type in prepare, I'll send you the breakdown so you can do it yourself, or reach out to me in the comments below. The truth is that there are millions of Canadians going through this exact same decision right now, and most of them are going to make it on emotion, and they're not going to look at analysis. They'll look at panic or they'll chase, but they're probably not going to make an educated decision. We're talking about the difference of hundreds of dollars per month. We're talking about thousands of dollars per year. We're talking about prepayment penalties that could equal $18,000 to $25,000. The choice on your side is variable, fixed, and realistically, what is it that it makes the most sense for your circumstance? There is no perfect answer in any of this equation. I'm Alex McFadden, and my job isn't to tell you which option to pick. My job is to give you the framework to make this decision. If this helped you to make the decision and you're looking for more support moving forward, you can reach out to me in the comments below, but I'd love to hear your feedback. Drop a note. Are you going variable? Are you going fixed right now?